Whether focusing on brand new credit cards or credit limit increases on existing credit cards, I'm grateful to say that I've had tremendous success with many financial institutions in recent years. Everyone from American Express, Navy Federal, Chase Bank, Elon Financial, Goldman Sachs, and the list goes on. I've amassed over 6 figures in personal credit limits as well as 6 figures in business credit limits. And I've put that formula on this channel in countless videos. I want to give you another one of those hidden diamonds in the rough when it comes to how to structure your applications and how to present yourself with these institutions so you can continue to have great success with similar financial institutions on your journey. So before we get into that, I want to give you a brief introduction and a little bit of context on the opportunity for you to get involved with the success of this channel. Okay, before we get back on top, you have some excess capital that your bank's no longer paying you that same return on. Now the interest rates are down and you're looking for a stable, purposeful, and profitable place to invest your money. But if I told you can support one of your favorite content creators while still earning a respectable return on your money? Yeah, that's right. The platform sponsoring this video is called Oversubscribe. It's a SEC regulated platform that's connecting the audience and the creator like never before. It's an opportunity for you to invest in this channel and share in the profitability in this channel as it grows. There's no commitment right now, but there's a link in the description. You want to learn more? Fill out the quick form and let's get in motion. You don't stumble across credit card approvals at the rate that I have or the credit limit increase success that I've had with multiple institutions by accident. I literally have struck gold with these financial institutions, and I have been able to say that I've found perfect timing in displaying myself with these financial institutions when and how to apply for these new credit cards or credit limit increases. When you think about all of the different data points that I focus on this channel, when we start talking about how to structure your application, all of the different things that the underwriting is looking at, how they're looking at it, how you need to move and function, how you need to time your applications. These are all things that have accumulated into tremendous success for me and other viewers that are on this channel. That having been said, there's one particular cliche in the banking and lending space that I have not actually covered that really surmises how to have the level of success that I've had and others have had when it comes to growing your access to financial resources and credit cards and credit card limits. And that's going to be the old adage of banks loving to lend to you when you don't need it. There's a serious truth hidden behind that adage. In theory, one proposes the idea that banks are salivating at the opportunity to lend you money and other financial resources when you absolutely demonstrate on paper that you don't need it. Let's take a look at some of the metrics just as a recap to kind of put this in context that banks are looking for when they're looking to approve you for credit cards or credit limit increases. One of the main things they're going to be paying attention to is your income and your DTI. They want to make sure that you have a really healthy income, consistent income, and that you have a healthy expense to income ratio or debt to income ratio. Another major metric they're going to look at to approve you is going to be your credit score. They want to see that you have a great reputation of paying your bills on time and managing the debt that you already have. Another factor is going to be your credit report. That's going to really be the influential factor in the limits that you get. Do you have an extensive enough credit report? Have you been managing debt for a long enough period of time? Do you have a dense enough number of accounts to really gauge your ability to handle debt? Or are you kind of new at this and only been managing a couple new accounts at a time? Do you have comparable credit limits? If you're looking to apply for a credit card with a particular institution and they're trying to figure out, well, what are we comfortable lending this individual? One of the major things they're going to look at is the limits you already have managed. These are just a few of those factors. If they're fortunate enough, relationship banking kicks in, where you've been smart enough to start deposit relationships with these institutions, and they're also able to see spending habits. All of this factors in to getting your approval and getting great limits with banks. But it also gives the bank insight on how much you may need this capital and why is that so important. When you stop and think about financial institutions and what they're looking to accomplish when they're lending their money out, they want to lend their money out to people who are going to pay it back on time as agreed. They're also looking to scale their lending. This is why credit limit increases exist on credit cards, because credit cards by design are primarily spending tools that have borrowing capabilities on the back end. So banks are always looking for individuals who are poised for growth, and that can be any lending product. but especially when we're talking about credit cards. So how does this tie back to the adage of lending you money when you don't need it? Well, the ideal scenario that banks don't really say or put out on display, but you can see it laid out in the way they lend and the way that they approve us for cards and higher limits. Banks are always looking for individuals who are looking to use the money for growth purposes. What do I mean when I say that? When you think about credit cards and credit card limits, again, if they're designed for you to capture your spending on and pay off on the 30-day basis or basically by the end of your statement cycle, that means that banks aren't necessarily looking for you to borrow this money for an extended period of time. Now, there's 0% offers that entice you to do this, etc. But the bottom line is they really want you to spend money on these cards. This is where they make the bulk of their bread and butter on interchange fees. So if they are extending credit to you and all of the different data metrics that they've seen have shown that you're not only financially stable, you have great repayment history, you have an extensive credit report, credit profile, you have great comparable limits, etc., etc. What you're illustrating to the bank is that the only reason you're applying for more credit is because you have more capacity to spend or put that borrowed capital to good use. The only thing better for a bank than approving you for a credit card or any other lending product is being able to extend more credit to you. That's the only thing that gets better for them as a financial institution. This is why I often say the negative trope that banks have gotten over many decades and years of, making all this money off interest and looking to charge you late fees and, charging you off and wanting to crash your credit, etc., drown you in debt. It's an unhealthy stigma because yes, banks can be completely ruthless when you owe them money, when you don't pay as agreed. On the other side of that, nobody really is paying attention other than wealthy and successful people who play this game all the time. Most people aren't paying attention to the other side of banks and financial institutions. They literally roll out the red carpet to you when you are functioning as designed in their eyes, when you are using the credit that they give you to expand and grow your finances, when you're looking for more credit cards and credit card limits to make more purchases and still pay back as agreed. They're making more money. The same thing goes for other lending products. When you take out a mortgage, the only thing that they can enjoy more is if you cash out refi or take out a HELOC or take out another mortgage on a new property. Any lending product from mainstream brick and mortar banks or any lending institution, the way that they're going to grow that relationship or grow their bottom line through that relationship is extending you more credit. And that happens when you only need the credit for growth purposes. When you are demonstrating on your application through your income, your credit score, your credit report, your spending habits, your relationship banking habits, etc., that I am borrowing money or requesting access to more capital that I don't need. That basically means the only other reason you're going to be using this is because you have growth potential. You have more expenses that you can cover. You have more assets you're acquiring or valuable items that you're acquiring, etc. There's something of value you're doing with this money. Business capital, mortgage-related capital, and especially credit cards are designed ideally for growth. So the adage of banks wanting to lend you money when you don't need it, this is the other side of that. That stigma and that adage actually comes from people being denied repeatedly when they are providing those same data points we just went over, and those data points scream desperation. Banks literally shut the door, roll out security, close you off, and throw an X over it because they're not interested in people who are desperate for the money because it's already proof that you can't afford it. They're looking for individuals. This is why they love to lend to rich people. They're looking for individuals who are going to add value with this money. You're going to go out and make more purchases and pay it back. You're going to go out and acquire more assets or grow a business. This is what this money is for. This is what this leverage tool, this lending is really all about. So I'm going to pull it back down a little bit. This is what I wanted to provide for you, that mindset and the framework that has gotten me so much success with financial institutions. I've understood that in recent years. I've learned that if I want to have the best relationship, the best access, and best favor from the financial institutions I'm doing business with, when that includes the most approvals and the highest limits, etc., I have to demonstrate that I am a partner, a growth partner to these institutions. I have to present myself as someone looking to expand the pie, not take from the pie. I'm looking to grow the pie. When they give me money, I go out and put that money into the economy and I get it back in a way that grows my my bottom line so they can expend me more money and grow their bottom line. I hope this makes sense for you because it is a very powerful understanding to have greater success with these financial institutions. Comment down below. Let me know what you think about this topic. Let me know what your experience has been with financial institutions. Have you noticed that you have more and more success as you grow with these institutions? Do you have a history of being rejected by these banks? And can you tie it back to having data points that have demonstrated you to be desperate at that time? Comment down below and let us know a little bit more about your experience with these financial institutions around this topic. To all my pioneers, welcome back. To my new viewers, welcome in. I want each and every one of you to like, comment, share, and subscribe to the channel and support this channel so this channel can continue to support and reinvest back into you. Speaking of investing, there's an opportunity for you to invest directly in this channel and share in the profitability and revenue of this channel as it grows. I want you to check that out in the description down below with no obligation. Other than that, I want each and every one of my pioneers to stay focused, stay in motion. I'll see y'all soon.